Nischal Maheshwari, CEO Institutional Equities at Centrum Broking, Johnson right now with his perspective. Nischal, great having you in the opening week on NDTV Profit. Thanks for taking the time out. Are you guys as constructive? What is it that you're telling your clients now that we are nearing 21,500?
Morning, Neeraj. Morning to your viewers also and your other anchors. I think it's a good time. Basically, I think yesterday after Fed came out and said that no further rate hikes, there was less hawkishness, or I'm saying more of dovishness actually rather than hawkishness. And now rate plot saying, though Fed is saying 3 rate cuts, I think the market is factoring in 5 to 6. I think these are all good setups for risk on in the world markets. And we are seeing that in India also. So I do not see much problems on the horizon. Yesterday, I was just sitting down actually and trying to enumerate what all problems, what can go wrong in this market, because I think all positives are anyway right now factored in. So the biggest things which I see here is basically inflation coming back. I would want to actually quickly recount in 1975 when Paul Walker was doing the similar kind of stuff basically. And they cut the rates ahead of time basically, and inflation came roaring back. And that could be one challenge that market may face, or the world economies may face. And then they had to further hike and take up the rates to as high as 17, 19%, which is the Paul Walker era basically, which we all talk about. So I'm saying that is one possibility that you might see, and that might derail the whole market.
Nischal, given the current setup that we are seeing, it's almost a little bit like a Goldilocks era, right? Equities are looking good, debt markets are looking attractive, gold is looking good, currency to a certain extent is also showing some sort of euphoria given the dollar weakness we've seen. What is the strategy that you'd be advising on right now? Would a multi-asset strategy be something that investors should be considering at this stage?
If you really look at it, basically, I think a lower interest rate scenario is good for equities. May not be as good for debt, basically. I think the debt has played out pretty well, basically, till now. So a lower interest rate scenario would mean good for equities and other asset classes, maybe commodities. Because as the cost of borrowing goes down, basically, all these corporates are going to make higher profitability. And so I think more risk on more riskier assets is what one should be playing on, but I would say equities is something which you should be overweight now, rather than actually trying to look at other assets being a part of your portfolio.
Nischal, good morning. Tamanna here. Great to have you on NDTV Profit and speak with you. And you're absolutely right, overweight on equities. But then what within equities? You know, this whole question about whether large caps will now start firing comes into play. We've seen metals now have a great day, and IT a great day for a second time in a row. Your thoughts on these three segments, and if there's anything particular that you would veer towards?
Morning, Tamanna. Great to be back basically on NDTV again. So I think rate sensitive, as I was saying, basically a falling interest rate scenario, I think rate sensitive is what you should be looking at within the equity portfolio. So all rate sensitives, banks, autos, real estate, IT to an extent. I think these are the areas basically which you should be looking at. And given that the economies world over in a downward interest rate scenario is going to be start doing well, then you should be looking at commodities actually. So we are turning positive on metals and chemicals, both of them basically, another two sectors which have not done very well in the past few quarters. So we are turning positive on that. So rate sensitive plus commodities is what we are recommending.
Nischal, how do you feel about the large cap space? It's rather consistently being heard in the last couple of weeks now that there is a valuation gap, valuations look attractive, large caps have only really gone up 14-15%. Earnings growth is looking pretty solid as well. Do you believe the same? Do you think the gap between small and mid-cap and large-cap stocks will finally shrink in 2024? And hence, getting into the large-cap space is a good idea even now?
So I think large caps is the space basically we should be getting in because it's not performed well. And I think there is a good valuation cover which you have out there. I think most of the stocks are pretty safe to play with. So whether it is banks, large cap banks or large cap ITs, I think all these large cap stocks seems to be in a good play basically at this point of time. But I'm still not of the opinion that the valuation gap between the mid caps and large caps are going to shrink very considerably, because I think this whole rally has been driven by liquidity, and liquidity just seems to be coming very, very strongly into the small and mid caps. And given that it's difficult to acquire small and mid cap stocks because of liquidity issues, and now I'm saying liquidity is the stock market liquidity. People don't tend to sell away basically in a hurry. So, and given that you have so much money coming into the mid cap and small cap funds, they just continue to buy there. So till the FIs come back strongly into India, I think the gap is going to continue like that.
I just wanted your take on, and something we discussed this morning also on the show and on the editor's cut, the kind of very intense responses coming into any fund buying enterprises, any kind of fund buying news. You have fund buying attempts by any level of company, and you have huge money chasing this. Why do you think this is happening? Is this sustainable? And in this, is there a concern that money starts chasing assets or companies that perhaps aren't that great in this frenzy?
So I wouldn't at the moment go out and say that we are in a bubble phase as yet. But I think these are the signs of creating a bubble, actually, where you are saying that some of these stocks are up 3-4 times. I'm saying we do not cover a recently listed stock, IRIDA. Now, I do not understand basically the stock has gone up 4 times from the point of listing. So whether so we do not cover it, so I cannot say. But I'm saying this is a clear sign of money chasing, or the retail chasing these kind of assets. But we are in early stages of bubble formation because economy is still doing pretty well. World economy is doing pretty well, and interest rates are going down. So I think this may go on for a while.
What is your view on some of the new age tech companies? The Zomatos, PBA, FinTech, Nykaa, Delivery. We are seeing some activity on these counters in the last few days, but nothing much to write home about. Any of these new age tech companies you would look to buy? Because I do think valuations there might be a little more compelling than the rest of the pack.
I think none of them have any valuation because nobody makes money. So all of them are whatever infinite fees. So what you have to look at is basically what kind of business model they have and what kind of potential they have. I have held my view basically for a long time. I think among the 4 of them, I'm only convinced about one business model, which is Zomato. They have created a niche for themselves, and they have created a service which has now become a part of our life. All others, I'm not sure actually basically what kind of business models they are following and whether they'll survive in the next 5 years or not. So that's why among the 4 of them, basically what I like is Zomato. I to an extent liked Policy Bazaar, but after they have announced that they want to become a manufacturer of insurance, now they are competing with their own clients. I think there also, I think there is a bit of muddiness as far as their business model is concerned. Paytm, I'm not clear what they are doing actually, basically, so do not have much strong view about that.
Okay. Nischal, we have a conversation with Jammu and Kashmir Bank up next. Now, the reason I'm asking you about this, you may not have an individual view, but here are banks which are doing these fundraisers and they are getting lapped up and seeing demand, which is multiple times what is on offer. Any thoughts on why that could be the case? And I don't know if you guys cover J&K Bank, but if you do, then what's the house view there? I'm not asking for a buy or a sell, just trying to think of what some of these mid-sized banks could do in the times to come.
So Neeraj, you are in a Goldilocks scenario clearly as far as banking is concerned. You have got balance sheet, you have raised money basically, and there is a market basically where the credit is growing at 14-15%. So I'm saying at least immediately, whatever you lent in the last 1 year or you're going to lend in the next 1 or 2 years, your book is not seasoned enough for you to actually create NPAs again. So I think for the next 1.5 years, you will be in a Goldilocks scenario, and I think that's what market is playing. And I think the investors are also looking at saying that if it is reasonable valuation and if there is a upside of 15, 20, 25%, why not acquire it? So that's what my thought remains to be for most of these banking scenarios. Now, I think at least for the next 1 or 2 quarters, I think banking should continue to do pretty well. And in a falling interest rate scenario, historically, we've seen that banking always does well. So, so for the next 1 or 2 quarters, I think things are pretty good for them.
Just, as we wrap up, your closing thoughts in a market like this, जो बिल्कुल थकता नहीं है, what would be your outlook and your advice? Is it time to continue deploying fresh capital, sit on the sidelines, maybe wait till, Jan, Feb and see what happens there? What is your strategy? Are you already in the New Year's year-end mood, or is there more work to do?
So I think you should be 100% invested. There is no question about that, basically.
Yeah.
I still see there is a good upside in this market. And now you have to be very, very stock specific, basically, because I think the broader rally has already happened. I think 22,000 is a good level of Nifty, which I think the next 6 months should be achieved. And thereon we would all start worrying where are we headed. But individually, I think that would be only 10-12% upside from here. But I think individually stocks will give you maybe 30-40%. So you have to be now stock specific. I'm saying avoid stocks and businesses which you do not have very strong views about. I think this is not a time for you to now start going and acquiring them. And that's why I was saying basically you should be in large caps at this moment. It makes a lot of sense because I think large cap has underperformed now. I think at least it will continue to be a market performer going ahead. So, and the companies are there much better quality.
Right. Thank you, Nischal. Good talking to you this morning. That's the verdict coming in on the street. You should be 100% invested. We are heading towards a bubble, but still not there yet in so many words.